All right, welcome to the Explainer. Today we're going to tackle something that honestly affects pretty much everything, from how much your vacation costs to the price tag on your new phone. And the big question is, why does the value of money itself seem to be constantly on the move?
Okay, let's kick things off with a little puzzle, something you might have actually run into. So picture this, you're looking at an imported car. The sticker price in, say, Japan hasn't changed a bit, but for you here, the cost in dollars could literally jump by thousands overnight. How is that even possible? Well, it all boils down to one single, constantly changing number.
And yep, that number is the exchange rate. So what is it? It's really just the price of one country's money in terms of another country's money. Think of it like a translation dictionary for prices. It's how we figure out what something that costs yen is going to cost us in dollars.
Right, so when that price, that exchange rate starts to move, you hear all this talk on the news about strong dollars or weak euros. But what does that actually mean, like for you and your money?
The idea itself is pretty straightforward, but the impact, it's huge. So, when a currency appreciates, that just means it's getting stronger. Your $1 can now buy more of another currency. And that's great news if you're buying imported stuff, because it gets cheaper. But on the flip side, when it depreciates, it gets weaker. Your dollar buys less, and suddenly those exact same imported goods get more expensive.
Okay, let's circle back to that car we were talking about. So its price tag is 2.5 million Japanese yen. Now, if the dollar is having a good day, if it's strong, you might only need about 25,600 bucks to buy it. Hey, not bad, right?
But check this out. What happens if the dollar gets weaker? All of a sudden, you need almost $28,000 to get that same 2.5 million yen. Nothing about the car changed. The price in Japan is exactly the same, but the cost to you just shot up by over $2,000. That is the power of exchange rates in the real world.
So this begs the question, right? Where are these prices actually being decided? Well, it all happens in this absolutely massive global marketplace that honestly makes most other markets look tiny. We're talking about the foreign exchange market. And just to give you a sense of scale here, even way back in 2010, we're talking about $4 trillion changing hands every single day. I mean, it's a number that's almost impossible to wrap your head around. And you better believe it's even bigger today. So who in the world is trading all this money? It's definitely not just us swapping a few bucks for vacation. No. This market is dominated by the big dogs, commercial banks, huge investment firms, pension funds, you name it. And these guys are moving absolutely gigantic sums of money around, mostly as investments. Okay, so here's the million-dollar question, or maybe the trillion-dollar question. What's driving the decisions of all these big players? What's making these exchange rates jump all over the place? Well, it really all comes down to one simple thing.
Here's the trick. You have to stop thinking of currencies as just cash you spend. Start thinking of them more like assets, like a stock or a bond. These big investors are basically shopping around the world, looking for the place to park their money, the currency that's going to give them the absolute best return. And their whole decision-making process really boils down to two key questions. First, pretty simple, what's the interest rate? Obviously, a higher interest rate is going to look pretty good. But the second question is just as crucial. What do they think is going to happen to the value of that currency down the road?
Let's look at an example. So, on the surface, a euro deposit paying 4% interest looks like a total slam dunk compared to a US dollar deposit paying just 2%, right? But, and this is a huge but, what if all the big investors expect the euro to lose 3% of its value over the year? Well, suddenly that juicy 4% interest rate gets almost completely wiped out by the drop in value. Your total return is now only about 1%. And just like that, the 2% dollar deposit is actually the smarter move.
So, when everything is in balance, when the total expected return on a dollar deposit is the same as a euro deposit or any two currencies, we hit this state of equilibrium. And that's got a name. It's called interest parity. It's basically the market's theoretical balance point. There's no major advantage to holding one currency over the other, so the frantic buying and selling cools down, and the exchange rate kind of stabilizes. For a little while anyway.
And this leads us to what I think is the most fascinating part of this whole thing. It's almost psychological. It's about the unbelievable power of what people believe will happen.
See, in the world of foreign exchange, what traders and investors think is going to happen tomorrow can have a massive, immediate effect on what happens right now today. And it's not some kind of magic, it's just pure market dynamics.
So here's how that works. Let's say a rumor starts, and investors begin to believe the euro is about to get stronger. What does every single one of them do?
They rush to buy euros right now to get in before the price goes up. But think about it. When everybody rushes to buy the same thing, what happens? That massive surge in demand forces the price up instantly. So the expectation, the belief, that the euro will get stronger is the very thing that made it stronger. It's a classic self-fulfilling prophecy.
So what does this all mean? Well, the next time you see a news headline about the dollar being strong or weak, you'll know what's really going on behind the scenes. It's not just some dry academic economic theory. It's the result of this huge global hunt for the best return on investment, a hunt that's driven by cold, hard interest rates, but also powerfully shaped by what we all collectively believe is going to happen next. It's a global machine running on numbers and a whole lot of human psychology.